Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, in today's show, we have Ian Bezek back on the show. Ian, thanks for joining us.
It's good to be back.
Always great to talk to you, Ian. And you've been on the show a number of times and you've been on a number of summits with us as well. So always a great interview. And Ian recently wrote an article on Seeking Alpha entitled "How Much Worse Can It Get for Philip Morris?" And an article that caught my attention. And so I was eager to track Ian down. And as always, he was kind enough to join me for an interview. So we're going to discuss the article here today. And Ian, for people who have yet to read that article, do you mind just giving a brief overview of the thesis and kind of what you discussed?
Sure. Yeah, I would say about 2 years ago, Philip Morris had reached $120 a share. And over the past year or so, it's fallen now to $80 a share. So it's down by a third, which for a company as dependable, that's as loved as a blue chip for yield investors, to see their stock drop by a third is a pretty substantial move. And so my readers were asking, is Philip Morris, is Altria are they finally cheap now? And so I went and I was expecting to find that the answer would be yes. Historically, tobacco companies have performed great over the years. In fact, over the past 80 years in the U.S. market, tobacco stocks have beaten all other sectors. They've beaten food, they've beaten oil, they've beaten alcohol. They've been number one. And so I was expecting to see, Philip Morris is down by a third, it should be cheap now. But upon further reflection, it appears that the price now is probably fair, but it's certainly not, in my opinion, a big bargain at $80 a share.
So what's going wrong? I mean, I have some assumptions in my mind, but so what, historically they've been a great investment. What's the problem now?
Yeah, I would say in terms of the history versus now, the biggest issue is that when you look at these historical returns, like Altria was one of the best performing stocks of the past 50 years. But it traded for much of that stretch in an 8, 9, 10 PE ratio because they had the government threat hanging over their heads. Like at any time, the courts could have decided the tobacco lawsuit and essentially put them out of business, depending on how large the damages were. And so you had investors pricing these stocks as though there was a real chance that the industry would no longer exist. And so if you bought at 8 times earnings, you were getting 8, 9% dividends every year. You reinvest that in the stock, you make a huge profit. But now at $120 a share, Philip Morris was selling for more than 20 times earnings. And so when you pay 20 times instead of 8 times, you get far less value for your purchase.
Okay, so and this may be an ignorant question, but that's one of the reasons why I'm asking you the questions instead of myself. So you're mentioning Altria. What's the relation between Philip Morris and Altria?
Sure, there was a split up a few years ago where Philip Morris got the international tobacco business and Altria got the U.S.-based business.
Ah, gotcha. Okay, great. Okay, and so but right now they're fully separate companies.
I believe they're fully separate. Yes, they came from the same brand heritage and all, and there's talk that maybe someday in the future they'll come back together. Right now, one is the international play. I'd say Philip Morris has often been more popular because it has the emerging markets, and so people still think maybe there can be some growth there, whereas the U.S. market is unlikely to ever grow for cigarettes again.
Okay, and so with that in mind, you mentioned Altria, which is historically the U.S. version of Philip Morris. We'll just say that because I feel like Philip Morris is obviously the more recognized brand, and so it's for listeners. So Altria, the U.S. portion, was one of the best performing stocks for many years. It traded at an 8 to 9 PE because of regulatory overhang. Investors were getting an 8 to 9% dividend every year, which obviously, like I said, makes for a really great ongoing return, especially when you factor in, I'm sure, some healthy appreciation. But then you said Philip Morris was trading at 20 times earnings. And so, okay, and you said the split happened 2 to 3 years ago. Do you remember, or how many years ago did Philip Morris and Altria split?
At least a decade ago.
Okay. Gotcha. Okay, this is making more sense. So that means, okay, and so Philip Morris, though, had been trading for around 20 at PE. And so basically what you found when you started researching is the PE is actually coming back down toward a more historical level with look where Altria has been as opposed to the high flying multiple it has been trading at.
Yeah, I haven't checked since I wrote the article, but if I remember correctly, Altria is now at about 12 times forward earnings, and Philip Morris is around 14, and so that's much more historically normal. But it's not back to the sorts of bargain valuation you were getting 20 years ago for those stocks.
Okay, so now both of them are trading around 12 to 14 PE or so. Okay. Well, my assumption is that, it's for years and years, obviously, the, smoking, I feel like the popularity of smoking has been rapidly declining in the U.S., and I'm assuming that's probably true for most of the developed nations as well. Because even when I hear that, I was born in the 70s, and when I hear the name Philip Morris, I didn't grow up smoking, but like my grandparents' generation, everyone smoked, so you went from that, 60, 70 years ago to today when, there's, at least among a significant portion of the population, there is a very unhealthy connotation with cigarette smoking and tobacco in general. And I think the biggest name in the business from my perspective is Philip Morris. So it makes sense that first of all, it makes sense that they made Philip Morris the international brand and changed their US, the name here in the domestically. But my assumption is that overhang is just finally catching up with them. Is it that simple, or you think there's more to it?
I think you also have the yield trade that up until 2016, investors were wanting to buy stocks that they viewed as paying a high safe yield. And so you looked at a Philip Morris paying a 4.5% dividend. You compare it to the 10-year treasury that was paying 1.5%. People said, "Oh, why wouldn't I own the stock?" Not realizing that when interest rates went back up, that people would demand a much higher yield for the Philip Morris stock as well.
Gotcha. So you think the yield, the chasing yield dynamic is not as intense as it once was because interest rates are rising. What else? What else do you think is going on? I mean, what have the numbers from a company perspective been hurting or declining? I think like the thesis I shared a while ago. I mean, is there legitimacy to that? Is that just purely my perception?
Oh, I think you're on the right trail. And then also, Philip Morris has a new product called IQOS that focuses on heating the tobacco rather than burning it, which is supposed to be more. It's supposed to minimize the health risk of consumption. And initially, it had been taking off very well in Japan, which has been kind of the first big market that they've launched it in. But this past quarter, the growth rate declined pretty significantly for that. And investors had placed a lot of faith in that kind of helping to take over as cigarette sales dropped off. And so I think a lot of people had to lower their long-term forecasts in case this new technology isn't a silver bullet.
So you've got a company whose core product is declining from a popularity perspective. And I mean, their core product. Okay, actually, before I say that, can you, just for clarity purposes, what are some of the primary brands, like consumer-facing brands, that would be associated with Altria and Philip Morris?
Don't have that in front of me.
Okay, because I'm thinking. I mean, is this again? I assume is Marlboro? I mean, isn't that one of their? Am I totally off base?
Yeah, I believe that's right. I've never smoked. So.
No, it's fine. No, I totally I might have blindsided you with a question, which is fine. Here, let's pull it up real quick. And this is one of those situations where I'm sure a listener is like screaming right now, "Don't you know what the brand is?" I'm sorry, I don't, but that's where I was having this interview. Because basically, the only reason I say that, honestly, I guess we don't need that information, but in the U.S. and I believe in Europe as well, man, when you look at a big carton of cigarettes, on the front of it says, "Hey, this will kill you." And that says that is big or bigger than the brand label on the cigarettes. And so you think, and obviously there's a highly addictive nature to tobacco, or I should not actually, there's a highly addictive nature to nicotine and cigarettes. And so, obviously that can overcome the incredible warning label that comes on the product. But I guess it makes sense that a company whose product says this will kill you in huge letters on their because the government required them to put that on there, it makes sense there's going to be a massive overhang in terms of sales on their product. And so that's a big drag. And then on top of that, the yield is not as attractive as it used to be.
Mm-hmm. But yeah, I think that's a huge point, that brands are losing their viability there. That's one of the risks that I always get asked about with the alcohol stocks, which I own so many of. But like, if we get similar warning labels on alcohol, who's going to buy a $40 bottle of vodka rather than a $10 one when there's no discernible difference in the product other than the label? So I think that's a big risk for tobacco and potentially for alcohol, depending on where the government goes in the future.
Sure. Yeah, I had not considered that. That would be interesting. Of course, you do have with alcohol, you have the prohibition historical dynamic to know that people go to very, very significant lengths to continue to have alcohol. So it'd be interesting to see how much a label would deter that. Of course, you also have the dynamic too, and I think this probably has been true with tobacco. For example, if say I have smoked my entire life and then all of a sudden there's a warning label that says this will kill you on it. If I haven't been experiencing significant health problems, or if the addiction is strong enough, it's probably not going to affect me that much because I'm like, well, I've tried to stop 15 times. It didn't work. And so this label, I've just accepted the reality maybe. Versus maybe with alcohol, I can see a dynamic where people think I've been drinking my entire life and there's a label here, but I'm responsible and reasonable. So yeah, I could definitely see a lot of consumer rationalization taking place for both brands, or both products, I should say.
I think the big issue is it's much harder to get youth to try something for the first time if it's very clear that there will be massive downside to using the product. And that's why cigarettes have had a slow decline, because they have their lifetime users that will probably, most of them, continue using until they pass away. But if youths don't pick it up, then you don't have a business 1 or 2 generations out.
Right. Which, again, the thesis of why the decline has been slower but is catching up right now has, e-cigarettes and things like that. I assume those are areas that that Altria and Philip Morris have attempted. And do you have any idea how much success those have been having? Yeah,
and that's what I mentioned with the IQOS product.
Oh, okay. Is that basically, so is again, I don't.
No, it's a different product, but
okay.
They're trying a variety of different things. I think really the only big market big enough to replace what they're doing now would be marijuana if it's legalized nationally.
That was going to be my next conversation. Yeah.
Yeah. I think that's really the only long-term avenue to growth that these companies would have.
It is a funny dynamic where you've got, not completely simultaneously, but, in fairly parallel, you've got this long decline for tobacco products. And at the same time, and largely due to government regulation and warnings, at the same time, you have an increasing level of support. And it seems, the trend seems to be going in favor of, whether people like it or not, legalizing marijuana. I believe it's already happened in Canada. If my memory serves me correctly recently, I think that happened. And then it did. Okay, right.
We're recording this. I'm not sure when.
Yeah, this is late June 2018, but I'm pretty sure it was like the last few, I guess maybe the beginning of this month actually that happened. And from things that I see, it sounds like there's growing support in the U.S. Congress and other places to do something similar in the U.S. I have no idea when that will happen or if it will happen, but it sounds like it's definitely trending in that direction. So it's kind of interesting that those things will happen in parallel.
Yeah. I think if you look way back at the history, back to like the 1920s and 30s, a lot of the initial concern about marijuana came from the fact that it was more used by Hispanics, more used by Mexicans back then, and there was some racial and some class-based arguments for banning marijuana back then, and we didn't know anything about the lung cancer risk with tobacco. And so one of them got preferential treatment from the government compared to the other. But now kind of the reasons for having opposed marijuana have gone away. And meanwhile, there's a very clear downside to tobacco usage.
Well, and just the dynamic too of I'm sure lobbying power. I mean, obviously it would be naive to think that a company like Philip Morris and related companies did not put forth significant efforts to maintain preferential treatment.
Mm-hmm.
So do you have, and again, like, as you mentioned, Philip Morris is not a company that you own. It's not a company you follow directly. And so you wrote this article because you had readers and subscribers who were asking you about the company. So you did some research. And so knowing that it's not one you follow as closely, in your research, did you find much about steps that they maybe are hoping to take or open to taking in the event that marijuana were legalized in the U.S.?
I would assume that they will start trying to build out their own brands and obtain distribution. I think at this point it's still not legal in enough places for them to really be able to do much. But
Right.
we'll see. We'll see what happens with the Canadian market, because that's kind of the first big nation that has done something.
Right. And Philip Morris. And so,
I'm curious.
go ahead. Sorry.
I'm curious to see though if, like, so much of I grew up in Colorado, so much of the community I see there, the people I know, they're very committed to supporting whatever local people, local businesses, local shops. And so I'm curious if the big guys will be able to monopolize the market, because it feels like the smaller brands have a chance to really build now, because they've been operating for years before the big money can get involved.
Yeah, that would
We'll
be
see.
interesting.
It may
Yeah.
just drive the buyout premiums that Altria and Philip Morris will have to pay to get into the market.
Right.
We'll see.
Right. Well, yeah, it would be interesting to look into like what new markets, how new markets typically evolve like that, because I'm sure there's a pretty standard process for how that stuff happens. You have new young companies that come in and start stuff, then the big guys come in and start acquiring to build up their to kind of fill in the gaps or close the gaps, I should say. So I'm sure they'd be quick to do that as well.
I think the interesting difference here is you had a large illegal market for this product for many years. And so there's already kind of a supply chain, and there's already been people who've been involved in it for a long time. Whereas
Interesting,
normally
yeah. Right.
Businesses like Google and Facebook have done stuff that a mature company never would have gotten away with, because the government would have said, no, you can't do that. But when the regulators don't understand a new product, it gives the entrepreneurs a much wider room to operate. But this will be the opposite, because now the regulators are already worried about how's this going to affect the children. They're going to increase like social problems, stuff like that. And so you'll have a much different environment for the entrepreneurs in this space.
Well, you've got a situation where it's already illegal and they're kind of backing down, as opposed to no pre-existing regulation.
Mm-hmm.
And so when it comes back to Philip Morris and Altria, and in terms of whether or not it's a good deal at current prices, I guess it sounds like it really comes down to whether or not an investor is satisfied with the yield.
Mm-hmm. Exactly.
Yeah, at current prices, it's a much better value than it was at 120. It sounds like. So if an investor, just reading some of the comments, obviously, there are a number of people have expected different opinions, and obviously the people were making comments about the dividend and things like that. And so it sounds like if you're satisfied with the dividend that Altria or Philip Morris is paying, then great. But I guess you also have to keep in mind that which direction are sales and is the company trending? And I may have asked that earlier. Do you remember? Is there a very distinct trend in terms of downward or upward or status quo regarding sales for Altria and Philip Morris?
For Philip Morris in particular, revenues have shrunk by 1% a year compounded for the past 5 years, and free cash flow has declined by almost 3%.
Okay, that's
so
bad.
Not catastrophic, but it's in the wrong direction.
Right.
The thing I would point out with the yield argument, because certainly it is an attractive yield at more than 5%, but keep in mind that your balance sheet has $30 billion of net debt on it, and so compared to a market cap of 125, so you've got like a quarter of the cap structure's debt, and that's not a terrible balance sheet, but it's certainly like you look, it's trading at a 14 PE ratio, but you've got this debt hidden behind the stock, and that debt will be a bigger problem in the future because your revenues, your net income is going down, and so it's like, yeah, they've bought back stock and they've paid a huge dividend in past years, but they've done it by taking on more and more debt, and you can't do that forever when your revenues are going down and your debt's going up. That's not a workable model forever. And
right.
So
well, okay, so they've been funding their dividend and buybacks through debt.
I believe they can pay the entirety of the dividend out of their cash flow, but then the other financial maneuvers have required debt.
Right.
Which is fine when interest rates are 1%, but not so good if interest rates go back up.
Right. Of course, it's a whole nother conversation. And a very interesting conversation as well. Let me think. So you said $30 billion of debt, and you said that was basically one quarter of their balance sheet?
Mm-hmm.
Okay, great. Cool.
Or of their cap, like the market cap's 125.
The market cap, right.
Which is not a terrible number, but it's just for a business that's shrinking, that's quite a bit of debt to have to deal with.
Right. And to your point, and and obviously a lot of investors agree that if the yield is nice, but it's not worth that, and otherwise if it was, it'd still be trading at a 20 PE.
Mm-hmm.
Right. Cool.
And I think the thing is you can get that kind of yield from other stocks like telecom, like AT&T's yielding more than 6%. I believe Verizon's in the mid 5s. And those businesses don't have great growth prospects either, but they're not likely to outright shrink.
Right.
People will keep using their cell phones. There may be a limit to how many more data plans how much bigger their data plan needs to be, but that business is not going to become obsolete in the near term.
Right.
I'd rather dividend. If I'm just buying a stock for the dividend, I'd rather buy that, or I'd rather buy a preferred stock where I get my 6% and there's no risk. Well, there's not going to be capital gains, but you don't have equity risk either because it's a preferred. So you get your interest every year. Why would I want to take the risk of my stock going down 30% just to get a 5% dividend?
So unless people start trading in their smartphones for cigarettes, Philip Morris probably isn't the best option.
Yeah, not at today's price. I mean, markets tend to overreact. I like to say that stocks rarely stop at fair value, and so if Philip Morris goes into the 60s, then I think you have this conversation again, and you can make a pretty good case for buying it, even you say revenues will keep declining at 2% a year, but if your yield up front is 6.5%, then that's great. That's fine. But at today's price, I don't think it makes sense.
Great. Hey, Ian, anything else you want to cover that I haven't asked before we sign off?
No, I think that sums it up.
Awesome. Hey, as always, a pleasure, and thanks for sharing your expertise with us.
It's been great.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.